Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct with Dukascopy TV. With all eyes on the US for that interest rate hike, I spoke to Ben Brun at OptionsXpress following Friday's NFP bonanza to find out exactly what US sentiment could mean for the Australian markets. Ben Brun, thank you so much for joining us today. It's a pleasure to see you again.
Lovely to see you, Natalie.
Okay, so we had NFP Friday. We're going cross coast for a moment. Now that data came in at a higher than expected 280,000 versus the anticipated 226,000. Is US data now becoming a little more hit than miss?
Well, it's very patchy, I must say. That first quarter data was quite soft in the round, and I think that was culminated in the GDP number, which came in at a contraction. So was certainly a big focal point for the markets, certainly in months gone by. The non-farm payrolls have consistently been really, really strong. I think we've been averaging about 250,000 jobs created each and every month for the last little while. So the pleasing sign, I guess, interestingly came with the unemployment rate, which actually rose, but that just showed that the participation rate was actually increasing. So the jobs have been a very, very strong highlight for the US economy. Other data, it's been a little bit patchy, so I think the second half is going to be absolutely crucial to just see, to get a bit of an idea in terms of what's happening, especially with the Fed.
Well, exactly. That really does tie into the big question, really, of when the US Fed will make that hike. Is September sort of still the big bet?
I think so. I think Janet Yellen has basically said there is one, possibly two, coming by the end of 2015. So whether that's September or even December, I guess the jury's still out and it's still very, very data dependent. But I'm certainly of the belief that they're going to pick themselves up off the canvas with probably two. So my idea would be a September and maybe again in December. And I think that's what the market's strongly pricing in. At least interest rate futures markets are suggesting that.
It is certainly looking to an interesting second half of the year. Now, an IMF official has warned really about the negative overspill really of that hike, and also sort of the preamble to that hike, as we saw with the taper tantrum previously, bringing it sort of more domestically. Are we already seeing examples of that on the Australian share market?
Yes, we are. Well, the bond market volatility, I mean, that has sort of washed through equity markets across the globe, but it seems to have struck a chord a little bit more here in Australia than anything. Obviously, we've got some sectors that are very, very strong when it comes to high yielding stocks. So they tend to be sold off more significantly with bond market volatility, and it's pulled back. And of course, we had Bill Gross saying that German bunds were the short of a lifetime. What a great trade that's turned out to be so far. And of course, yields are rising. They're up around, well, the highest levels that we've seen in a very, very long time out of the US, on full expectations that we're going to get a rate rise from Janet Yellen and co. very, very soon. So yes, I mean, it's not the best news story for share markets. That is just almost they're just so used to the stimulus measures and the morphine drip that markets have been kept on for the last little while. So that's where it's just adding a dimension of uncertainty. But overall, the interest rates going up in the US is not necessarily a bad thing. It's actually a good thing because the US economy is running off its own steam.
We know that any US action always has that sort of Aussie dollar shift really as well. Even the RBA noted in their last meeting minutes regarding sort of the dominance that US Fed is playing. How does all of this really play into Aussie dollar price action?
Oh, it has a very, very big impact. Now, if we got a Fed rate rise once, maybe twice by the end of the year, I would expect that the Aussie dollar would start with a 6 handle at this stage, all things being equal. Now, that is on the proviso that the RBA returns to a full easing bias, which last week they didn't really surprise the markets. They came out and they just delivered the outlook statement. Didn't seem to be an easing bias, but certain commentators and analysts are saying there's an implied easing bias. And if we get some further RBA decisions that allude to that, given easing outlook, then that's just going to add to that sinking feeling, I'd suggest, for the Australian dollar overall, against obviously the US dollar, where the economy is expected to raise interest rates. So polar opposites at this stage should add to the downward trajectory for the Aussie, I'd suggest.
Ben, always great to receive your insight. Thank you very much for joining us today.
Thank you, Natalie.
That is all we've got time for right now. However, do stay tuned as I'll be back with plenty more exclusive interviews for you right here from the heart of the APAC region. Goodbye.